Imagine you own a hotel. You've got 100 rooms. Guests check in, drop their bags, and head out to explore the city. At any given time, only about 10 of those guests are actually in their rooms. The other 90? Out sightseeing, eating dinner, living their lives. So what if you just rented those 90 empty rooms to other travelers, charged them a nightly rate, pocketed the cash? And as long as all 100 original guests don't come back at the exact same time, nobody ever knows. Sounds sketchy, right? That's literally how every bank in America works. When you deposit $1,000, you think you're putting money in a vault, like checking into a hotel and your suitcase is sitting right there on the bed. But that's not what happens. You're actually lending the bank your money. That checking account is basically an IOU. Your deposit is like handing over your luggage. The hotel says we'll keep it safe, but the second you walk out, they're renting your stuff to other guests. In 2024, U.S. banks held roughly $17.4 trillion in deposits. And what do they pay you? The average savings rate is 0.45%. That tiny bar of soap in your hotel room, that's the interest they pay you. Here's where the hotel starts printing money. Those 90 rooms where guests are out exploring, the hotel rents them to new travelers. Banks do the exact same thing. They take your deposit and lend it out. Car loans at 7%. Mortgages at 6.5%, credit cards at 24%. The difference between what they pay you and what they charge borrowers is called the net interest margin. JP Morgan Chase reported $89.3 billion in net interest income in 2024. $89 billion from renting out rooms that belong to other people. The hotel doesn't just rent empty rooms, it overbooks, way overbooks. 100 guests have checked in, but the hotel sells 90 more reservations. Now there are 190 guests for 100 rooms. This is fractional reserve banking. That $90 they lent out, the borrower spends it, it ends up in another bank, that bank lends out 81, and so on. Your original $100 can create up to $1,000 circulating in the economy. Banks literally create money by lending it into existence. And since March 2020, the Fed dropped the reserve requirement to 0. The hotel doesn't just make money from room rates. There's the pool, the gym, the restaurant, the minibar. Banks have their own version. It's called fee income. ATM fees, $3 to $5 each. Overdraft fees, $35 per transaction. Monthly maintenance fees, $12 a month just for having an account. In 2023, U.S. banks collected over $5.8 billion in overdraft fees alone. And just like that overpriced hotel minibar, these fees hit the people who can least afford them the hardest. Every hotel has a fire code, maximum occupancy. Banks have their version, regulation. The Federal Reserve, the FDIC, and the OCC all set rules about how much risk a bank can take. Capital requirements, stress tests, Basel III, and then there's FDIC insurance, like the hotel saying if the building burns down, we'll replace everything in your room up to $250,000. This insurance is what keeps the whole system from collapsing. The nightmare scenario, every single guest showing up at the same time demanding their room. In banking, this is called a bank run. Silicon Valley Bank in March 2023, depositors tried to withdraw $42 billion in a single day. The bank didn't have it. Within 48 hours, SVB was dead. This is why too big to fail exists. In 2008, the government bailed out the banks, $700 billion in TARP funds. The hotel was burning down and the fire department used taxpayer money to rebuild it. So, the next time you deposit your paycheck, remember, you're not storing money. You're checking into a hotel that immediately rents out your room, overbooks the building, charges you for the minibar, and hopes everyone doesn't show up at once demanding their bed. Banks make money on the spread, on fees, and by creating new money through fractional reserve lending. It only works as long as trust holds. This is Make Stock Money. We'll see you in the next one.